So what I want to discuss today is trading earnings the probability-based way. Those of you that are members of the room probably have a pretty good handle on what I do, but I think I just thought, well, it occurred to me, I don't know why, sometimes it takes you a long time to put stuff together, but I was thinking prior to the last quarter, I said I should start keeping my earnings numbers separate. I keep a detailed trade log, as most of you know, and I post it on the website periodically, probably not often enough, but I do post it periodically. But I thought, well, people ask me, well, how do you do on earnings? I said, well, I really don't know because I don't really ferret them out. So I began to keep a log in the fourth quarter, which was started October the 1st through December 31st. And got some interesting results, which I want to share. And I know that those that are members of the Optimizer group have already seen them, but we could talk about those a little bit. And it got me thinking, well, maybe I should do a presentation and I want to do a full course on how to trade earnings a probability-based way. So first of all, just a little bit of an overview of what I'm going to try to cover today. And what I'd like to ask it, there's not a lot of no questions during the session. I mean, I've got my chat detached, but if I can, perhaps I can scroll back and get them, but let me get through the stuff. I'll try to get through it in 45, 50 minutes. Most of it, you guys that spend some time with us during the week are probably familiar with most of it, but maybe for the newcomers and people that have an interest in learning how to trade earnings trades, it'll make some sense and generate some questions. And I'm pretty much free, so I'll stay here as long as you like to answer questions after the presentation. So what I want to talk about is basically as an overview is, what is an earnings play? And an earnings play to me is a trade that we execute obviously prior to earnings. Now this particular webinar, I can't go into detail on every single thing because we just don't have time. I think we could probably spend a day on almost every one of these 6 topics, and there's certainly a lot more to do. So we're not going to go into finite detail about how to do everything, but I want to give those that aren't familiar with this an idea of maybe it's something you should consider adding if you're not currently doing earnings plays, something in your portfolio. So in earnings announcements, I'm sure you're aware of this. Most companies that we trade have quarterly earnings, so they come out once a quarter, obviously. And typically, they're on the start about the second week of January and the second week of April, et cetera, July and then October. So that's what we're looking to trade in, and I'll get into a little bit of detail on where that opportunity is. So let's commence. Now, as I mentioned, an overview. I'm not going to get into finite detail, but I hope I can generate enough interest in some questions that, and there aren't any dumb questions, so please don't hesitate to ask them at the end of the day, and we'll just sit here and try to knock them out. Now, before I get into the presentation, this is my favorite slide, and you guys that have seen me know it, but somehow I figured out how to do GIFs, but I put this on there, and I want to make it clear that I really do know nothing. I mean, it's all about probabilities and statistics. The old adage in trading is the people that buy options are those that tell the best stories at the parties, but those that sell options are the ones that drive the best cars. So I always thought that was kind of interesting because, you always hear about the guy that, well, I bought this XYZ option at this price and it went to gazillion, but you don't hear about all the other stories. So anyway, we'll move forward. So what is an earnings trade or play? I don't even know where they come up with these terms, but to me, it's just really a regular trade compressed in time. And what I mean by that is most of the trades that we typically do are 45 days to expiration. Obviously, we can't put, if we go, that would only mean we can only do one trades on one particular day a month. But our sweet spot is to put trades on with 45 days to expiration, and we begin to manage them at when there's 21 days left. And that's, right out of the Tasty Trade playbook. I'm the first to admit I've been with those guys since the day they started. I've got a dog tag, a low number, and learned a heck of a lot. And their research to me is impeccable. I know a lot of guys diss them, but that's I followed the methodology, and it's worked very well for me. So historically, like I said, I never really pulled I never pulled the earnings trades out. I never kept separated. And to me, it was a trade. But so an earnings trade, if you can think of it, rather than just putting on at 45 days and letting it go, managing it at 21 days or according to the mechanical criteria that we use, an earnings trade, we're typically putting that thing on if the earnings are going to be announced after the market closes or before the market opens the next day. We want to get that trade on before the market closes so we can participate in what occurs in an earnings trade, and you'll see what edge we're looking for. I also think that an earnings trade is a great engagement tool. Even if you're a new trader, I wouldn't suggest you do a lot of them or do every one that we do, but they're a great engagement tool because in my mind, it compresses the time frame, and when we get into it, I think it'll make a little bit more sense. But now you're trading, instead of trading a trade with 45 days and expect to be in it 20, 25 days, something like that. Now you're looking to be in it a day. That all doesn't always work that way, but we're looking to be in it for one day. So I think it's a great engagement tool. Again, I wouldn't do some of the more advanced strategies or where you have a lot of naked exposure, and we can talk about that, but particularly happy to answer questions at the end of the day. And it's also an earnings trade is a trade that occurs, in my mind, it occurs within the earnings cycle. We're just getting into the earnings season for this next quarter. It'll begin hot and heavy next week. We already had a couple sprinkle in this week, but it'll be hot and heavy pretty much through January, mid-February, and then it kind of slows down a little bit as far as the number of opportunities on a daily basis. So the next question, in my mind, chronologically, is why in the world would you ever trade earnings releases? Well, again, like I said, I think they're a great engagement tool. You can learn a lot about trading options. Again, keep the size small, but you can learn how to trade a variety of strategies and how to manage them in a much more compressed period of time. Sometimes it's a little more stressful, but if you manage them correctly, mechanically and unemotionally, that should not be an issue. I said earlier, I think earnings trades accelerate the learning curve, just like any good education. I think, and like my slide there, I know nothing. I really don't know anything. The only thing I can do is help people maybe not make the mistakes I make. Everything that I have no proprietary information. Everything that I use and do and trade is right there on the option chain. I don't look at portfolio or technical analysis. I don't look different performance criteria, etc. It's all right there in front of me. I have no insider, and I don't even think I would help. I have no insider information. So I think the fact that if you trade some earnings, at least on a small scale, trade the earnings release, it'll really accelerate your learning curve. And not so much on the trades that work, but on the ones that don't work, how to manage them and not accept them as a binary event, win or lose. The other thing, and I'm a baby boomer, like probably many of us here, is it's instant gratification. Most trades we're putting on with 45 days to go. We're either exiting them by the time there's 21 days left to go, or we're managing them in some form. Most of the earnings trades, and you'll see when I show you the detail, our best trades, we put them on the last hour of the day, and we take them off the first 30 minutes of the next day. Now, I'm not going to tell you that happens all the time, but that's our goal. So we find out win, lose, draw in a pretty short period of time for a variety of reasons. Now, I think it's important to know the most important metrics for earnings. And I've made myself some notes here that I wanted to mention, just so you really have your head around it. Again, I'm not a directional trader, and I'll talk about that a little bit, but there are some metrics that are important, and it's not different squiggly lines on a chart. It's not RSI, it's not MACD and all that stuff. But what the most important is implied volatility. And those of you I'm presuming that most of the people in here are at least somewhat advanced, and some of this might be a little over the head of beginning traders, but implied volatility is what drives the price of the options. And that you'll see when we go through this, the implied volatility is typically higher, expanded in front of a binary event. So implied volatility is one of the most important metrics that we'll talk about. Now, we also talk about implied volatility rank, which is a way to look at the implied volatility number of the particular stock relative to itself. Implied volatility is one number. Implied volatility rank is another number. I won't go into great detail on that today, but excuse me, that implied volatility is the real metric where we're looking to, the higher it is, the more premium we're going to generate for our option trades. Another important thing about implied volatility is it is mean reverting. So if we're in a situation, and you'll see with most earnings trades and most binary events that volatility is expanded somewhat, and we're playing for that contraction that occurs after the binary event information is known. So if volatility, if you can picture like it oscillates up before an earnings trade, and then it'll come down after what is speculated is known as fact. That volatility contraction is part of the process. Now, the other thing to understand, and I've alluded to it there, is that volatility is typically highest prior to a binary event. Now, the most common binary event, and the ones we're talking about today, are earnings plays. There's some other binary events that occur, particularly if you trade some of the FDA stocks or biotechs. You're always at risk for binary events there. But for earnings trades, that's the binary event that we're primarily trading. Primarily trading, and that I want to show you on an option chain what I mean by that. So let me bring up the option chain here. Let me show this up here real quick. I'm going to put in a trade. If you're familiar with, and I can use Thinkorswim or Tastyworks. Let's look at Apple. Let's look at Roku. I know I could show you some that have this week. I'll collapse all these different chains. But if you look out here on the right, you're going to see these various implied volatilities for that week. The week of January 17th is 63%. The next week it's 60%. But here, when you see this aberration on the week of the 21st, 77%, that should tell you that there's some kind of a binary event that's going to occur that week. And probably if we check, and I don't know when Roku's earnings are, yeah, they're on 2/20. So their expiration day is the 21st. They're the day before expiration. So that's where you get this expansion in volatility. You get a higher volatility number, which is something that is of benefit to us because we're going to, in most cases, be playing that volatility contraction. I just wanted that, and you can see after the earnings event, it will normalize. Now this week we've got some JP Morgan is coming out. The financials start, and you can see it's just a little bit higher. It's 28%, but JP Morgan's normally, not a real volatile stock. So you can see how it kind of normalizes in the low 20s, and that 28 will probably come down to 21, 22, 23. But in any event, volatility is a little bit higher for the week coming because of the unknown binary event. The other important metric, and I'll put the option chain back up there for you, is expected move. All right, there's a couple of things to look at. There's a market maker move up here, which it says $3.40. That's typically for 1 day. That isn't always populated, that field, because it's typically populated a day or so before earnings. And then you've also got over here on the right, it's an expected move this week on JP Morgan of plus or minus $4.22. That's a 1 standard deviation move, something we'll also talk about. So those are the expected move. We can calculate it with the back of the napkin calculation, and I can share that with you. But it's all right here in front of you on the option chain, all the information you really need to know. And really the final thing we'll look at, most of the earnings plays that we trade are centered around that 1 standard deviation move. So I'm not going to go into the log normal distribution today. I think that's a whole different course, but for all intent and purposes, we're looking at around a 16 delta, 17 delta area. And you'll see right here it's 14. So if we were going to do a 1 standard deviation triangle, we would sell this 141, and we'd probably come down here and sell either the 130 or 131. So those are the real key metrics: the volatility, the fact that it is somewhat mean reverting, and understand where the expected move is. Because what we're going to do in earnings trades, by and large, are not directional trades. Instead of trying to pick direction, we're going to pick where we think the stock won't go. And why short premium versus long premium? When I say short premium, that means short premium strategies. We do. We sell puts and we sell calls, and a combination of those. And That's what kind of gets me about the industry. All these fancy names they come up with. They're just either a short call or a long call, a short put or a long put, or a combination of those. But they have to call them strangles and straddles and all these different things just to make them, I guess, easier to communicate. We know that if we sell a strangle, we're selling an out of the money call and an out of the money put. Ironically, that's not the most popular strategy that I use in trading earnings, and we'll see that a little bit later. But the challenge with long premium, if you've studied stocks for any period of time, it's a 50-50 shot picking the direction in a stock. And I don't know how many times I've experienced this, and I'm sure you probably have too, where you own a stock, the earnings come out, and the earnings are great. The CEO says the long-term forecast is great. The CFO says everything's great, and the stock tanks. And you're sitting there in disbelief. Why did that happen? And conversely, I've had it where the bad earnings report, bad forecast, and the stock goes up. So to try to play directionally, to me, in the short run, is a real challenge. And I think it's one that it's not. I don't think it's a profitable particular way to go. If you're lucky, it's great. I mean, they're like lottery tickets. I mean, if you had who had the, or I can't think of one had earnings recently. Bed Bath & Beyond we traded this week. It went down. If you were short Bed Bath & Beyond, you did great. But I think it's important to get it through your mind that picking direction, at least on a short-term basis, and we're talking about a very short-term basis, a day or two, is really, really a challenge. So if we sell premium, we're typically going to be selling it where we think the stock won't go. That's the one standard deviation and expected move, et cetera. And I'll show you a little bit of that. But that's, to me, is the big advantage. And think of it this way also, picking direction is 50-50. And if we're out trying to do one standard deviation trades, we've got about a 70% probability statistically of not losing money if we saw a strangle, a short call, a short put. But historically, the fact that implied volatility is overstated, we're going to find that our winning percentage will be a little bit higher than that. Now, how and when to trade earnings releases? We could spend all day on this. Maybe we should sometime. But the way that I do it is I review earnings that are going to be released after the market or before the market on a particular day. So like on Monday, this coming Monday, I'll be looking at, is there anything that's coming out after the market closes on Monday or before the market opens on Tuesday? Now, I've got a sheet that I'll bring it up that I use, and I will share with you. And okay, so you should see, let me get rid of that band there. Okay, so what this is, now, the first thing I want to state is I'm not aware of any source that has 100% accuracy in earnings dates. So I've played earnings before when they're supposed to come out Monday after the market close and they don't. So you're going to have to confirm everything. But the source that I'm using now, and I don't know if Marco's, he was going to attend today, is Option Slam. I'll share that if we have some time here. I'd like to go over that tool with you a little bit. I'm just getting into it. I just started using it the last several months, and it is very accurate relative to dates. Because I used to look at Option Slam, and Earnings Whisper, and Tasty Trade, and everywhere to try to come up with it. And this is a pretty good way, efficient way to find earnings releases. And I'll share that with you if you're not familiar with it. Maybe it's a tool you should add to your quiver. And it's only it's like $199 a year or something. So we'll go over that a little bit. But so here, this is real world. And I've got this particular sheet that you're looking at is being populated with live data by Thinkorswim. So this is live data, the last prices, and these will obviously change when the market opens on Monday. But you can see, and I'm going to kind of highlight those. So we've got, on my list, I've got 5 stocks that I'll be looking at Monday, nothing after the market closes on Monday, but you've got Citigroup, JP Morgan, United Healthcare, Wells Fargo, and Delta Airlines. And those are the ones that I will consider doing earnings trades on. Now, I usually, I like to always do 1 or 2, but 2, 3, 4s, depending on what the opportunities are. And just the fact that they're having earnings doesn't necessarily mean I'm going to make a trade on it or not. But what I look at is we got obviously the last price. Here you'll see this market maker move in this column K. That is pulled right out of that where I showed you on the Thinkorswim chain. That's their anticipated one-day move. That'll probably change a little bit on Monday, but when we're near the end of the day, the last hour of the day, we'll be looking at that market maker move, and also we'll be looking at the weekly move, because when you're on Monday, obviously you've got 4 days to go till expiration on Friday, so there'll be a little more disparity on Monday between the market maker move and the weekly expected move. So then what I do is I haven't figured out a way, if someone's an Excel expert, I would appreciate, but how to parse this number. I get this number plus or minus. So what I've got to do is I go in there and I say, okay, let's just plug in $2.30, just pick a number. And you can see, I always want to see where the 1 and 2 standard deviation strangles, and we'll talk a little bit more about that. I don't want to get into that now, but this is how if I'm going to trade earnings, it's really pretty simple. Tell me which ones are going to have earnings before or after the market closes, say on Monday, or before the market opens on Tuesday. And then as we get into Tuesday, we'll look, okay, what is after the market close on Tuesday is UAL, before the market opens on Wednesday is Bank of America and Goldman Sachs, so on and so on. So it's really that simple. I don't go scanning through hundreds and thousands and whether 7,000 or 8,000 stocks. I have a watch list of the ones that I prefer to trade. That doesn't mean that if someone said, hey, John, or whatever, what about XYZ company? I'll take a look at it, but I've traded on this list of 150 or so stocks. I've traded them at least once or more times for earnings, and I'm going to begin to get a sense of how they work and how they perform. So that is the watch list that I'm currently using, and what I'll typically do, make a screenshot of this and post it in the Facebook group and in our private group in the morning or during the day sometime. So we can come back to that, but I want to share that with you. Now, typically, I prefer to place the order in the last hour of the day. That's not always possible. If I've got something going, I'll do it earlier in the day. And there's some pros and cons. In most cases, again, if you're playing the probabilities, the volatility will expand throughout the course of the day, and should be theoretically at its highest point near the end of the day. So the higher the volatility, the more premium I'm going to get, or maybe I'm going to get a little bit further away from price because of that expansion of volatility. Doesn't always work. In fact, sometimes it's a telltale sign. If they start to suck volatility out of it in the last hour of the day, you put in a strangle for $2 and you don't get filled, and that's $1.95. You keep chasing it down a little bit. They're starting to pull volatility out. Oftentimes, that's a good signal, particularly if you're doing a strategy like we do, where a strangle or something that we're trading where it won't go. The other advantage, I think, trading at the end of the day is you can pretty much center price. Some stocks don't move very much. You may take a stock like Amazon or Baba or some of these, Facebook, some of these will move a lot. And I'm sure you've experienced that through the course of the day. So the closer I can get to the end of the day, and if I'm going to do a non-directional trade, which I'm typically going to do, I'm going to be able to be a little more accurate where I want to place those wings. And I'll talk about that specifically. We'll take a look at maybe a couple of examples for next week. And then the other thing I like to look at is premiums are available. And that's kind of the deciding factor for me. Like Monday, we have 5 trades, potential 5 trades on Monday afternoon. If I look at a trade, and typically I look at a strangle first, and if it doesn't have enough premium, I'm probably going to pass on that one. So I'll look at both the current week and the monthly premiums to make a decision. But it's really pretty much that simple. Is trade the last hour of the day if I can. If I'm going to be doing something, I place it at noon and take my chances. And I'm going to wrap up here with my thought, and I want to go through a few things, my preferred strategies. Before I do, I talked about, and I should have interjected this earlier, I talked about last quarter. Again, I don't know why it never occurred to me to keep records just for earnings, because people would ask, well, how you do? I said, well, I really don't know. So let me show you what I'm talking about, and I probably should have showed this in an earlier slide, but this detailed trade log that you're seeing on the screen right now. Okay, these are every trade that we did starting October 2nd. I want to tell you that all these trades are live cash. It's my cash. They're all in about a $30,000 account, my regular small trading account. I only trade one lots. We have a number of members that trade much larger size. I want to trade one lot for a couple of reasons. First of all, I want to trade in a kind of a normal size so that most traders can relate to it. I've been involved in some trading rooms in that where these guys are trading, 100 lots and, making $1 million and all that. That's just not real world for most of us out there, nor should it be on range trades, take that kind of risk. But so these are all one lot trades. They're all actual numbers. I've executed 68 trades throughout in that 3-month period. I've closed 61 of them. I still have a few that are being a little annoying, and we'll talk about those because those are the most important ones. But this is the detail of every trade, and I'm happy to share that with you. Now, I also break them down by strategy, and picture that might be able to do this a little bit bigger. There's what I did of those 68 trades. This will show you line by line which strategies I used primarily. Most of my strategies, you can see, are 36% were strangles. And even wide strangles, there were 4, which is really, to me, is a wide iron condor is a synthetic strangle. And you can kind of lump those in the same thing. But that's primarily what I do. So that gives you an idea of the trades by strategy. You may say, well, I'm just starting. I only want to do defined risk. I'm going to do iron condors. Maybe I'll take a strangle that you're doing and to put wide wings on it, which I do too on more expensive stocks. Rarely do I do a directional, semi-directional trade like a credit spread. It can certainly be done. I do like ratio trades, and I like the double ratio, which is just a 1x2 put spread and a 1x2 call spread. But maybe that's a little bit bigger for you to see there. So that gives you an idea of when I finally did it. The summary to date, and again, I want to stress, I've got 7 straights still open. We can look at those because they could all be losers. I don't think they will be. Most of them are pretty close to breaking even. In fact, I even had planned on a slide where I showed what if I just closed them all today, what would it cost me? A couple, $300 or $400 or something. So this number might be $300 or $400 lower. I'm hoping to manage them to a scratch or a profitability. But I did 68 trades. I closed 61. I still have 7 open, as I mentioned. 58 winners. Of the ones we closed, 3 of them were losers. And the losers were some pretty big haircuts. You can see my net loss, my average loss. I like this to be about 2 to 1, but I took a real haircut in an Apple wide strangle. So that's going to happen. I mean, that's trading. So, but as long as you trade small and keep your risk consistent, your size consistent, so that'll give you an idea. So somewhere between 2,500 and 3,000 will probably be the final number. I'll certainly share that when it's wrapped up. I'm anxious to get it closed out too. Most trades that let me show you. People will ask me, how long are you in these trades? And you can see our preferred is to be in for a day or 2. And there's a lot of single digits, but there's some I'm in, some of them I'm managing them for a week or 2. There's a lot of 1s and 2s and 3s and 4s. And maybe I'll get that data, how many we close in 1 or 2. That's our preferred. We want to put it on, Monday afternoon. We're hoping we're going to put on trades on JP Morgan or whoever and take it off Monday afternoon, take it off Tuesday morning. Doesn't always happen. Now, some people treat them that way, and that's perfectly fine. Treat it as a binary event, put it on as an earning trade, take it off as an earning trade. Yeah, if I can manage them, that is my preferred way to do it. So that shares with you a little bit of what I do. So I'll briefly go into the strategies that I use. My go-to strategy is a strangle. I like to trade strangles. I like to trade around the 1 or 2 times the expected move. Historically, prior to this, I'd say the last 6 months, and the guys and girls that are members of the group, I think it's been about 6 months, I started doing strangles 2 times the expected move, but going out to the regular expiration. And I've been pretty happy with those for a variety of reasons. We don't have enough time today to talk about the whys and wherefores, but rather than I used to want to do the front week where you had the highest volatility, you had the most volatility contraction, and if the stock stayed within your expected move, you could take it off or let it expire worthless on Friday. That used to be the way I think. I'm moving a little more in the direction of giving myself more time. I collect more premium. I've got more time to manage it. I'm typically further away from price. So that's probably going to be a higher and higher percentage of what I do. I look at both. I look at the front week, depending on the price of the stock, the expected move, et cetera, and the other metrics that we talked about. And then I'll go and I'll revert and I'll look at the full month. So as an example, for Monday, I'll be looking at potential trades for the week that expire. What next week is? It was just the 10th, probably the 17th. And then also look for trades that expire on the options expiration for February is the 21st. So that'll give you a little idea. So strangles are my number one preferred strategy. Also that 2x strangle that I mentioned, let me show you. I think a picture's worth 1,000 words. Let me bring up the option chain. I think that'll maybe be a little more helpful. Okay, JP Morgan. As I said, the expected move is $3.40. Again, these aren't moving numbers. The markets are closed, but if this were how it looked at the end of the day, citing at about 340 on there, and I'd say, okay, you're around 139.5, 148. So I'd probably sell this one, and then I'd say take 340 off. And so that's what, 33, 32 and a half. And I'd probably be down here around just 32. This one I may even go because of the delta. I might sell something like that. Now there's no wrong answer in these things. You can be closer to the money, take a little more risk. This is a good example because the premium I'm collecting is $1. That makes my break even. If I'm short the 131 put, my break even's down here at 130 plus 6 cents. But so basically at the 14 delta. And on the top side, my break even's here at the 141. So it's a 14 delta. So that means, I got 28. So I got a 72% chance of not losing money on the trade. So that gives you an idea. The other way I would look at this trade potentially is, okay, it's got a 340 expected move. So let's double that. Just round numbers, 680. So we can say $7. Go out to the, and this is just one strategy, but if I got $7, see if there's any money out there at 143. I'd have to go to the 145. And take $7 up. What is that? It's 29. So I have to go to 130. So I would probably go down to this one. So I'd either that one, depending if the problem with JP Morgan, they don't have dollar wide strikes. See, and you probably find some examples with dollar wide strikes, and maybe they'll have some on Monday. I don't know. But so that would be a 2x strangle that I prefer to use, or I like to use, either the strangle or the 2x strangle. And again, that's the highest percentage of trades that I use. You can also, if you're a newer trader, you're not comfortable with undefined risk, say, okay, I'll take this, we'll sell this 20 delta strangle, and then a normal iron condor, we want to collect about a third of the width of the strike. We don't think about that on what I call a synthetic strangle or a really, really wide iron condor. I'd probably come down here somewhere and pay 5 or 6 cents for a wing. So let's see, we're at 140. So yeah, something like that. And you can mess around with those a little bit. I like to at least collect the dollars, so I might go out a little bit further. But now that would define your risk rather than unlimited risk. You've now defined your risk. $5 less 92 cents on the call side and about $8 on the put side. So that's another way, and I'll do that frequently. I'll do that on the Amazons of the world and Babasas that really move a lot. You can really get in your short. So I do put some protection on. But in my mind, this is really a strangle. It's the 140, 131 strangle. I've just put these wings on to define the risk. And that's perfectly fine. I mean, that's nothing wrong with that. Let's see, we got, let me look on the chain. Is there anything coming up? It's got a real high IV rank. Starbucks will have one, but Starbucks is 128. So, okay. That gives you kind of an overview. The other trade I like to do is ratio strangles. Let me find something that I don't think it's going to work out well on JP Morgan. Yeah, they got dollar wides. So what I'll do on a ratio, and you can do these in any ratio. I'll be long one option closer to the money and short two farther away. So, and let me show you that. So in this case, I would say, okay, what's the expected move? 340. You can use $4, whatever. So let's take $4. I take 140. So I would go out here and I would sell a couple of these 140s. And I'll typically do these during the front week. So I'm going to sell 2 of those 140s. And then let's see how much premium I got. Then if I can, I'll buy at 139. So I'm long, and I'll talk about this, long a 139, short two 140s. Now that would be on the call side. So if I collect 24 cents for that and JP Morgan goes down, I have zero risk to the downside. I keep my 24 cents, let it expire, or if you want to close it for whatever. And I'm not going to go into managing these things today. That would take too much time. But that is a 1/2 call ratio spread. Some people trade them 1/3, trade them 3/5, whatever. I'm typically 1/2. So, but that you can vary those a little bit. And I'd like to get further away if I can between the two strikes. But what happens in a trade like this? Think about this. You've got a 1/2, you've got a 139, 140 long call spread. So if JP Morgan goes to 140 and pins there, it stops there, that trade's worth $1. You've got an extra short call, which in theory should expire worthless. So the most that's going to be worth is $1. If it goes up, peels your face a little bit above 140, then that's gets into the management part of it. But you've got a 139 by 140 long call spread with an extra call. Now, the other thing I'll do is I might even do it on the put side. I call it a double ratio for lack of being, more creative. So let's see, we're 36, let's score 32. So we sell 2 of these and we buy a 33. Now that's what I would call a double ratio spread. So what I've really got here is I've got the 139, 140 debit call spread. I got a 133, 132 debit put spread. But because of the extra shorts, I'm really short the 140, 132 strangle. So I kind of call this a strangle on steroids. If this thing goes outside the range, you're going to get $1 for either goes on the put side or the call side, plus the 76 cents you collect. So that's $1.76. So what that does is if you take the $1.76 premium and you add it to your 140, that gets your break even up to 140, 176. So let's just say around one. So you got about 10%, maybe because it's kind of in the between your 11, 12% chance. And on the bottom side, if we take 132 less $1.76, we're 130.25. So let's look at the 131. So we're kind of in this area, right around the 14% area. So a strategy that I'll do often that's another one of my go-to or favorite strategies on the weeklies. So more trade the weeklies. So I'll do strangles, 2x strangles, ratio spreads, double ratio spreads. I will occasionally do a straddle. Again, all that is selling. I probably wouldn't do it on the stock like JP Morgan. I might do it. Let's see what Citi. With something with a small move, well, that's not too bad. Citigroup has only got an expected move of a couple of dollars, so you could come in here and sell. If you could sell the 79, something like that. What I want to make sure is I'm collecting enough money to cover my expected move. You are covering the one day, not the weekly expected move. And you could obviously, if you're a little more bearish, you could go down to the 79 level. But I don't use straddles a whole lot. And I also take a straddle and put wings on it, make it an iron butterfly. Like in this case, I would probably go down about $4.75. And go up $4 to 83. So this would be a perfectly good trade that met my criteria. I'm collecting $2. I like to collect close to the market maker with a one-day move. I'd like to get a little bit more, but what I've done is define risk. So I'm collecting $2. I've got the most I can lose on either side is $4 less the 213 credit, so $1.87. So that would be they call it an iron fly. That's just another way to define risk on a strategy. And again, I don't want to spend a whole lot of time going into every single trade and every single strategy because I want to leave you plenty of time for questions. And I'm at 45 minutes, and I wanted to see if there's anything else I want to share with you. And I'd like to open the floor for questions and help in any way I can. Let's see. Let's see if there's anything in my file here. Just give me a second. We've talked the watch list. We show the strategies, a summary, the detail. I might add, I'm working on and planning a. Let's see. Where's my? Sorry, Okay. I wanted to bring up a Word doc. I'm working on a course and that I'm going to be offering that goes into much more detail. And I'm also thinking about offering this for the next quarter also, but I'm going to be developing a course, and it gets most of the stuff, a lot of the stuff that I just barely touched on today, I want to be covering in that. And that's something I'll be certain to be posting all the nuances and everything relative to it. I'm considering doing this over the next quarter, where we would, for a subscription, you have access to the room every day that we trade in there. And then once a week, we do a webinar like this for an hour or two and try to cover each of these sections and really drill down the detail on everything that's important. Again, why we do earnings trades, how to find the best ones, the most important metrics you need to know, strategy selection, execution. The big thing, and we didn't cover it today because you really need to see it in action, is how to trade trades gone wild. I call them trades gone wild. Managing trades that did not work. If you choose to do that, some people just choose to say, okay, it's a losing trade, take it off and move on. I'm more in the camp. If it's manageable, I like to manage it. And then I want to spend some time on how to record. If you have an interest in recording trades, you'll certainly be welcome to the sheet and everything. And then we'll wrap it up. And so I'm considering a 3-month coaching program on that. And I'll have the details. I should have had them by now, but I don't have the details for today. So that really wraps up all my slides and what I wanted to cover. I got done in about 47 minutes. So
thanks for your participation and attendance. Let me answer some questions from the attendees.
Okay. John, you asked which group. I have a private membership group where I have a live Skype chat and a live trading room. We actually trade futures, project the futures charts for most of the day. Got a number of guys and girls that like to trade futures. And then when 9:30 comes around, we start looking for option trades. And I keep the charts up most of the day. We're mostly done around 11, but if questions come up, I'm there in the live room to answer questions. We'll bring up a trading platform. So if you have an interest, just shoot me a little note. I'll give you the specifics on that. Limits to place trades. Your question. Yeah, well, if I want to get in an earnings trade, sure, I'm going to go in with a limit price and on that. But I'm not. If I want to really be in the trade, I don't know if Delta Airlines has any more. Let's see let me find the highest volatility rank one here. Yeah, Delta's the highest volatility ranks. Okay. So if I were going to do just let's look at the regular weekly strat. I'm going to do one. It's going to move about $2. So I'm going to be 57 and 61. So I'm going to probably sell something like this, 57. See that there's not enough credit for there to do it. So I would defer to the February, and now I'd look at can I do something for around $3.5, $4, say 55 and 60. So now I got to be a little more aggressive like that. But now I'm getting over $1. So you ask about a limit. And let's say that this one doesn't particularly, a little close to the call side, but let's just say this worked. And yeah, I would put that out probably at the mid. I don't really dance around these too much. I'll typically offer it at the mid at a limit price. And then if it doesn't get filled, I do cancel and replace. Depending on what time of day, especially if it's late in the day and I want to get in this trade, I'll hit this, go cancel and replace, go to 140 or 139 until I finally get filled. So I start out as a limit number, and I end up I end up the day with a if I want to get into trade, I get into trade. Now, of course, there's points I won't go to. I mean, if they start sucking the vol out of this one down to $1, I'm probably going to just pass on it. But yeah, I would enter the trade as a limit. Let's go to that. What was it? DAL. If you do it, if I did the trade here, Delta. This isn't the best example, but I would put that in, and they're $1.40 mid, and I'd hit review and send, and then it comes up working. If I don't get filled, I just change it and go to replace the trade. So if that helps, I say, yeah, it looks like you understand that. Okay, so good. Okay. So okay, Vern. Hey, Vern, how you doing? Nice to see you. Are you up in Canada or you come down to Florida? I know you said you get down here like I thought in January or something. Why not post trade? Why not trade post earnings as you know which way the stock moved? Well, Vern, I will. Yeah, and I have done that. There's often times that I don't get in a trade, or I've already got too many earnings trades, and if the vol's still there, I'll do it. But I would say the most of my trades are going to be pre-earnings announcement. I understand where you're going with that. You're going to get volatility contraction. The challenge that you'll have, and you can get on good trades. I mean, sometimes they don't. The volatility is not going to come in a whole lot on JP Morgan. So it might still be there. If the IV rank's still there in the morning, you will get less premium. But to your point of being, hey, now I know what it's going to do. Now I can center the strangle or whatever strategy I do relative to that. Yeah, I mean, that's good. I just would choose to do it pre-earnings because the reality is, I mean, these are if we do a strangle, it's an undefined risk trade. But the way the brokers evaluate the risk is about the 5 delta. So if I'm short, let's just say I'm short this 20 delta strangle about. Again, I wouldn't take it. It's only 69 cents. So I'm taking in 60. My real risk, yeah, it's unlimited. But my real risk is probably 2 standard deviations. And I intended to cover that a little bit today, but it takes a while to really talk about, the standard distribution curve, which we use all the time. I mean, 70% of the time, the price is going to be contained within that 1 standard deviation. 95% of the time, it's going to be contained within 2. So you got to basically, 2.5% chance on either side. So yeah, okay, 57 to 54. Yeah, I'm really risking $300, less about 70, so $230. So that that is why. But yeah, there's nothing wrong with doing that. If you find success doing that, and like you'll find it more. My experience, again, my first thing, if I don't get filled on Delta Airlines, maybe I'll look out at next, on Tuesday morning after earnings come out and try to find something. But the larger stocks, Vern, that are more expensive, they still may have enough premium in there. If I could go now, what I would do, at least for me, what I would do is if I didn't get filled on Delta, I would go to and I jumped on it Tuesday morning after the earnings. After the earnings announcement? I would go to the regular February, whatever the next regular expiration is, and I'd probably try to put a strangle or a ratio spread or something on for that period of time. I wouldn't do the weeklies anymore. That day there wouldn't be enough premium in there. So I hope that answered your question. Okay, Mike. Yeah, thanks. I should have your email. Oh, you're welcome, Vern. I should have your email so I can. Happy to send you some information, or if you want to jump on a phone call, discuss it with you. No big deal. Can you copy the current values on the sheet and share with us, please? Current values on what sheet, Julio? The earnings sheet? This one here? That's the earnings sheet? Oh, okay. Yeah, I mean, I'm happy. This is if you have Thinkorswim, yeah, I'll send it. I got you on Skype, Julia, so I'll just plug it in Skype for you. If you've got Thinkorswim, it should populate for you. Again, and I did want to mention. I said I would mention option slam because I told Marco. Well, let me show you that a little bit. But y'all. I do check these periodically. There's still a few that haven't announced, and there's a big difference in earnings whether the earnings is confirmed or not, and that's where you get messed up sometimes on the dates. Now here I'll show you my option slam. I've got the full membership, and what I mostly use it for, I used to use it. You don't even have to have the paid version to use the earnings calendar, but you've got some limits as far as what you can let's see. See, it's showing after the close on Monday and before the close. Some of the same ones we talked about. But what I was able to do is load in, and I'm learning more about this. You can go into screening and all that. I'm not really into that because I like to trade, my database of stocks and, with occasional. So I've got all my stocks listed here on my watch list that's on that earnings watch list that I'm showing you. And you can even, I think you can export this in Excel and all that, but it shows you the next earnings date, Alcoa, January 15th after the close, American Airlines, January 23rd before the open. You can also sort them you can sort them by the earnings date, so you can have them this way. He's got a tremendous amount of information. I'm not one to use past results as an indication of future earnings or future. So I don't really rely too much on the past, but just click. There's JP Morgan. There's charts in there. You can go down all these. You get all this information. I'm an insider, but I guess maybe I'm not long in the right page, but it'll show you, the October 15th earnings, what happened before the high, low, close. He uses a metric called EVR. Again, I'm not too interested in what JP Morgan did last time. I know some people look at, very diligently at the last 8 or 10 earnings and say, okay, well, they moved about 4.2% and all that, and that's what I'm doing. I only want to know what's going on today, what's right in front of me, based on what the implied volatility is, or the implied volatility ranking, and what premiums they're going to pay me. I want to get paid. So, well, Al, thanks for that compliment. None, I appreciate it. So that's Option Slam. He's got a ton of stuff in here that I haven't even gotten through. Like I said, there's you can get earnings histories, trend analysis. I think it's $199 a year, $200 if you want to trade them, that could be one trade for you. Now, Vern talked about post earnings. I haven't looked too much at this because I don't really use that type of event. But he's got they can the 10 most recent earnings, this EVR rating, which is rates of from 0 to 10 on being the most volatile. I can look and see what's the most volatile. So, I'm typically looking for, I'm not playing directionally. So I'm going to place those earnings trades the day of, before the end of the day, like we talked about. Some people choose to do earnings trades in advance of earnings, do long premium strategies, and then take them off 4 or 5 days or whatever before earnings. I don't have any experience with that. So that I used, and I got it just to try to have one source. Yeah, I'll be happy. I'll do that, John. Yeah, I will happy to. Thank you. Yeah, thank you for your interest. I'll be happy to do that. And if you want to jump on a call, let me know. I'm going to be here today. I'm not golfing or anything today. So this just something I thought I would mention. You'll probably, as I get more familiar with other tools in here, you'll probably see me talking about it more in the private room, private group. So that's you got all these different. Again, I haven't even begun to use it. I was happy to have one source where I could set up, and people do bring me one. I think Friday someone brought me a trade coming up at earnings, but I looked at it, it didn't have enough liquidity for me. But the thing that I'll leave you with is we all go through that thing. When I started trading earnings, I wanted to trade every earnings trade that was out there, and you're much better off trading those that are the most liquid with the tightest bid-ask spreads. I mean, I can name you train wreck after train wreck, where even companies like Smuckers that you look at them, boy, looks too good to be true. It typically is. So once you get familiar with different companies, you won't have as much anxiety of putting on a strangle on a company like Disney. Because that means Disney. Here, let's see, where is Disney on the sheet? I tell people regular trades, the first strangle I put on, my hands were shaking, but I don't even think about it anymore. There's Disney. It's got an IV rank of 60. So we've got till February 4th. So we got 3 weeks before that. But Here, I mean, a 2 standard deviation move on Disney. Let me put that in there right now. The market makers. Let's just put $4. So okay, you're looking at basically plus or minus $16 range. So it's just not gonna. Okay, John. Yeah, I'll give you a call. Yeah, Mike, I recorded it. I'm going. Kids are important. I'm gonna edit it a little bit. I'll download it and then into Camtasia and I'll edit it. So, but yeah, if you're around today, I'll be happy to call you, John. I'm going to be here for a little while, like I said. So, but that's the thing. If you start trading, somebody brings you. I mean, if you want to buy options and buy lottery tickets on thinly traded stocks, that's a whole different genre, a whole different area that I'm in. What I want to trade stuff that I'm basically to trade where I think they won't go. I know that, I'm going to be right 70, 80% of the time. And the times that I'm wrong typically are manageable. I got whacked pretty good on Tesla. That wasn't even an earnings trade. But a couple of years ago on Netflix. But you get more and more knowledgeable. Those of you that are more experienced, where we start out as a strangle and this thing just, peels our face off one way or the other to the upside. We'll roll the untested side just like they teach us. And I can show you, I want to show you a trade here. Let me find it on my regular, because it wasn't an earnings trade. Now this doesn't happen all the time, but there is. I always treated every single trade as a binary event. I mean, I put the trade on win or lose. And I know I have some members that will put a trade on and it goes against you day one, and they're a little anxious about that. Well, first of all, when you put on a short premium trade, the minute you put it on, if you took it off, you're probably going to have a losing trade just because of the bid-ask spread. But you have to begin to trust the math and trust the probabilities and be confident in what you're doing and knowing exactly what you're going to do mechanically and unemotionally when you have to adjust it. Now here's a trade, and I can show you some real bad ones here. Here's Google was a horrible mess. I still got 24 trades open after the end of the year, but last year trade to one lot, we were up about 13,000. Now I've got some. I'm going to take a couple hits there, but I got a couple good ones. What I want to show you is if you don't give up on and you know how to do stuff mechanically, and I don't like to use the word, but I do, puke it out. I've got this Roku trade, started out as a double ratio, and I expect, I'd like to make, maybe sold it for $99, maybe make $150. This thing had me in blue jeans and gym shoes. And if I showed you, well, I could show you on my Tastyworks platform as an example, all the adjustments. But these are mechanical, they're unemotional. Let's see, when did that trade start? 8-7. Let me bring this up. 8-7. And I've got a few of these. I've mentioned that I think I'm going to make some case studies. And again, it's not knowing anything. So this starts at the bottom. Here's the original trade. You can see all the adjustments I've made on this trade. So I'm up about $1,000 in premium. And that was not what that's supposed to do. But okay, Rashish, thanks for coming. Appreciate it. But it's not. I don't think every trade's a binary event. Now, if you trade a lot of $3 wide credit spreads, you don't have a lot of flexibility. Which is why I've kind of migrated to more strangles as much as my account will allow. But I like strangles the most. But you can really, it's not over till, it's like what Yogi Bear says, it's not over till I say it's over. It's not over till it's over or something. So what John Belushi said, it wasn't over when the Germans attacked Pearl Harbor, one of my favorite lines. But so the point is that in most cases, and the wider you are in these strangles, in most cases, you've got opportunity to manage them. You're going to have some doozies. I mean, you're going to have, $700 loss like that one. I mean, that was totally mismanaged. And the other reason that I like to keep detailed records is I will be reviewing now. These are normal. But what the heck did I do wrong on one that I took a defined risk trade? Now that was NIO. That was stupid. I listened to that. Somebody said, take a look at NIO, and I traded it. But why did I take a defined risk trade where I had a maximum loss of $300? I turned in 600 or 700 trying to be a hero or something. But by keeping the detail, which is I kind of think it's fun. At least I get better every year. So let's see. Any other questions? I don't think so. It'll probably take me a while to get this thing rendered and everything. Julio, I'll fire over that spreadsheet to you. If you have think or swim, it should populate. You're going to probably have to put some of these custom scripts on it on some of those cells, but I can help you with it. Yeah, I agree, David. So, well, I don't see any other questions. Maybe it was dull and boring, but I hope you got something out of it. For those of you members, I'll see you guys Monday morning. The rest of you, don't hesitate to reach out. I'll contact those of you that had an interest, and I will see you later. Have a great day. Good luck. Great trading. Thanks for coming. Oh, you're welcome, Jonathan. Hey, look forward to meeting you, Jonathan. We'll get together for coffee or tea or something. So, yeah. Hey, Mike, thank you. Ken, hey, you're welcome. Thanks for coming. I appreciate it. Hey, Larry. So, appreciate it. Go out and have some, those of you in Southwest Florida, go have some fun. The weather's gorgeous.